Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, Josh and I, we're going to be taking you on that journey we talked about to talk about different types of accounts for your investments.
Yeah. You mean there's more than one?
There's maybe only two.
Okay.
No, there's a lot more than that.
There's a lot. And actually, we should say we're not going to actually talk about every type of account.
That would be a long episode.
We're going to talk about the main ones you will probably encounter and the differences between those. But there are many different small, minute account types. But in general, they fall into three big categories.
Three.
Taxable accounts.
Yep.
Tax-free accounts.
Wait, really?
Yep. Tax-free accounts. And then tax-deferred. Deferred meaning you're putting it off for later.
Wait. So we were just talking about this before we hit the record button, but everything is taxed at some point.
At some point, the government wants tax.
They want their cut.
They want something from you earning.
So we'll talk about how that is for each kind of segment of accounts here. So Josh, first up.
Yes.
Taxable accounts.
Taxable accounts. So they have different names to it. They could be called an individual account, a joint account, brokerage account. So if you ever see brokerage in the word, usually that is a taxable account. And they're called taxable in that throughout the time frame, they're taxed every year. So while you have an account open like this, you are continuously being taxed on your investments in real time. And so the way that works for a taxable account is when you place a trade, when you sell, you're going to be taxed on the gains, on the growth on that investment.
Right.
Or if you have a loss, the tax is to your benefit. You still have a tax impact from that, which is a loss.
Yep.
The other thing that's taxed during that time frame is any kind of distributions.
Right.
So if I have a bond and it gives me interest, that interest is taxable. Now there's certain types of bonds that can be tax-free, blah, blah, blah. But if the interest is taxable, you get it when you receive it.
Same thing with like dividends.
Yes.
So if you were in a real estate investment trust, they have to pay out a large portion of their income in dividends. Mm-hmm. You're going to receive substantial percentage dividends compared to other stocks probably. Yes. That is taxable.
Yes. And so any time there is some sort of increase in value to you, the government will try to take a portion of that in taxes. Right. That's kind of the best way of looking at it. If it's a gain, if it's a dividend, if it's interest, any kind of, hey, this is more money than I had before, then they're going to say, hey, I want a part. Or even like kind of raise their hand and say, hey, you owe me a little bit of that.
Even like a mutual fund with a capital gains distribution.
Yes.
Same
and
kind
we'll talk
thing.
about that. There's less control over that because they pick when they give you this distribution, not you. So you may not even sell your mutual fund, but you may owe capital gains on it because within the underlying holdings, they've made some transactions.
So this is an example of a type of account that it just does not matter if you pull the money out of the account or not.
Nope.
If it is taxed regardless.
Yes.
So like different to what we'll talk about in a little bit, where you may have to take money out for it to be taxed or whatever. Mm-hmm. This is taxable in the account.
In the account, yeah. So at the end of the year, you'll get a tax form from whatever place that is held. If it's a bank or an investment firm or a custodian of some sort, they'll send you a tax form every year that shows those transactions throughout the year. All the income of interest and dividends paid in, plus any purchases and sales, so that then you see, okay, here's my total tax that I owe.
Right.
And you can offset some with others. So if I have one investment that's doing well and I sell it and I have a capital gains, then I have another investment that's not doing well, I could sell that and offset the two so I owe less taxes.
Right.
So there's things you can do to control your taxes, but either way, the tax is due every year.
And your holding period determines your tax rate on a lot of investments.
Yep.
So typically what these accounts are really good for is if you're going to hold something longer than a year, you can then, if you sell it at a gain or whatever, your dividends are still going to be taxed at short-term rates. But if you're holding something more than a year, you sell it at a gain, you're going to incur tax, but at the lower long-term capital gain rate.
Correct. So anything less than a year is whatever your income tax is.
Yep.
Anything held longer than a year, you're paid the capital gains rate, which is either 15 or 20%, depending on where you do fall in your income in your tax bracket. But either way, it's lower than your tax bracket. Actually, in the lowest income brackets, there's zero capital gains tax. So, if you're very low on income, then you actually don't pay any. But it's still shown up as a capital gain. Now, I will say some dividends are qualified where their tax is treated a little bit better as well.
Right.
So there is caveats to everything we're talking about. But I will say, too, when we're talking about that, you may say, well, that sounds like the worst type of account, always getting taxed on it.
Right.
Because you're always taxed, there is really no restrictions on this type of account.
You can take it out whenever you want for whatever you want.
You can do whatever you want with it when it comes to contributions and withdrawals. There's no restrictions.
Right.
And when it comes to what you hold within the account as well, they do not restrict what can be in there because they know they're going to be paying tax along the way. There's a lot of flexibility that comes with the way it's being taxed. And so this is a very flexible account, and a lot of people use it for shorter term goals because they don't have to worry about any kind of penalties or excess tax if they do need to take the money out.
So as of now, aside from cryptocurrency, you can probably hold anything.
Yes. Yep.
Now, that even someday may be an option, but as of right now, you have to have a special digital wallet or whatever for that.
Yep.
But the most flexible for putting in money, taking money out, and there's just what you want to invest in. It's just do what you want.
Yep.
So
that's great. Like I said, a lot of people say, okay, I'm saving up for a down payment on a house or something like that. This is a good account to use that for because there is no restrictions.
Right.
Because some of the accounts we're going to talk about that are more retirement based, you have to wait until you're 59 and a half or else you pay an extra tax penalty on top of your normal tax. And so with this having no restrictions, a lot of people will utilize this to do that, as well as there's no contribution limit. So if you're already maxing out all the other ways to save in retirement, there's no limit. You could put as much as you want into this type of account.
Let's shift gears.
One more thing before we do.
Ooh, don't shift gears yet. Put it back in
inheritance.
first.
So the last piece of this is what happens when it goes to the next generation. When someone inherits an account like this. So the benefit is it's being taxed. If, let's say, like Austin said, it's a long-term holding, so I bought it for $100, and now it's worth $1,000. So I have $900 of this capital gains that if I was to sell it, I would owe tax on that $900. Well, if I pass away and my kids inherit this, so they now have $1,000 of whatever this investment was, they get a step up to the day of my death. And so now their cost, what they purchased it for, in air quotes on a podcast, what they purchased it for is now whatever the price was on that day. So let's say it's that $1,000. So now they owe zero capital gains tax if they were to sell it that same day. And so for the next generation, it's actually a pretty efficient way of receiving something that maybe had a lot of tax built into it. If you give that to the next generation, they can a lot of times not pay any of that tax.
There are limits.
There are limits.
But that's a topic for another day.
When we talk through estate in another podcast, we'll walk through some of those. But the inheritance tax and all that, that's pretty high right now. It changes a lot when the government feels like they need more money. But right now, it's a pretty high that most people won't run into some of those issues. But in general, it is a nice inheritance piece because, again, the next generation does not have restrictions on it. There's no requirements on what they have to do with it. And more often than not, they are going to get at least a partial step up in cost basis so that it's at least a reduced amount of taxes they owe as opposed to the person prior.
So stay tuned for a episode where we talk about different states.
Estates.
Oh, estates. See, I see what you did there.
Estates, which will be a very exciting one. So make sure you drink coffee before listening to it so that you stay awake.
All right, so just like we almost did earlier, we got a little ahead of ourselves. Let's shift into second here.
Yes.
Different gear. Tax-free accounts.
That sounds great.
I think, so no tax ever?
Tax-free. Free of tax.
Free for no tax ever.
Well, like we said, the government wants their tax at some point. So tax-free accounts, with a couple exceptions, are usually money you put in after you pay tax on it.
Already paid tax.
But then it grows tax-free, and you do not owe tax on any amount that you withdraw in the future.
Correct.
Including the gains. And so, and we'll walk through that. The biggest ones you see is when you see the term Roth, R-O-T-H, Roth IRA or Roth 401k.
Like Josh Roth.
Yes, close. Different ending. But the idea there is These type of accounts, you're going to put in after tax, meaning you've paid your income tax on that money that you earned somehow, wherever it came from. And now when you put it into a Roth IRA, Roth 401k, from then on, since it's already been taxed, it can grow and you will not owe tax on the money you put in, nor on the growth of the money. So going back to my example, if I have $100 and I put in a Roth IRA and it grows to $1,000, I've already paid tax on the $100.
Yes.
I can withdraw that $1,000 once I meet all the rules that we'll talk about, and I owe no tax. So I got $900 of tax-free money, which is great.
That's a beautiful thing.
Yes. So a couple examples, though, that you actually don't owe any tax on would be a 529 plan. Is that money can go in, and you usually get a tax deduction depending on your state, but you can get a tax break for putting the money in.
Right.
And then it grows tax-free, and then you withdraw it tax-free. So that's a great place.
Yeah.
And then the health savings account, the HSA, is another example of that as well. You get a tax deduction for adding into your HSA, grows tax-free, and if you use it for medical expenses, tax-free.
Or you can even
or you
pull
wait
that
till your
out
retirement.
when you retire, and then you only pay the income tax on the gains.
Yes.
So
and that becomes like a tax deferred account
exactly
at that point, which we'll talk about
which
in a
is
second.
the next step. But we're getting ahead of ourselves. So let's talk a little bit more about this Roth business.
Yes.
Because it's not like unlimited tax-free growth.
Right.
There is a lot of limits involved because the government knows that Josh already paid tax on that $100, but he only paid tax on that $100. If it's going to grow a ton, you can't just have it unlimited, or else everyone's going to use this all the time.
Yes. So they put some restriction on it. They put income restrictions, and they put withdrawal age limits on it. And so what they're saying in a sense is we understand the benefit of this type of account, and we're going to limit especially the high income earners from taking too much advantage of this tax-free growth. Because a lot of times what you'll find out is if you're a high income earner, you have some pretty smart attorneys helping you avoid taxes in most instances. And so this benefit is not really for you. It's for the middle class, the average person to say, okay, I want to put some money in and I want to get as most efficient growth as possible to help for my retirement savings. So some of those stipulations, I'm not going to go through the income limits because they change periodically, and I don't know when you're going to be listening to this episode.
So check the IRS website, and they will have the most current.
Yes. So there is income limits, and how it works, though, is for singles, it's one level. If you file jointly, it's a higher level, and that applies for both people that are filing jointly. But then they phase it out. So they have a low end of income and a high end of income. If you're below the low income, then there's no restrictions you can put up to the max in, which, again, changes over time. In 2020, it's $6,000, but it goes up periodically. Then if you're in the in-between stage, they reduce it. So you may not be able to put the full $6,000 in, but you can still do something in a Roth.
Right.
Then once you hit your high income limit, then you just can't do a Roth at all. And so they're targeting this is created in the values for people who don't have extremely high income.
And there's also catch-ups.
Yes.
When you get to closer to retirement age.
Yes. So when you're 50 or over, you can do an extra amount of catch-up. So again, in 2020, it's $6,000 is your contribution, and you can do $1,000 catch-up. So you could do $7,000 into the Roth IRA if you meet the income limits.
So like Heinz catch-up.
Yes, it's the catch-up. And so the idea, though, again, is a lot of people are not doing what they need to save for retirement. And there's stats on that are very depressing. The idea there is they're giving an extra benefit. If you're in your 50s and trying to get to a spot where retirement is a lot more stable and have a higher probability of success, they give you that extra catch-up amount.
The sad part is that it almost should be flipped because of the power of compounding.
Yes.
It'd be nicer for younger people to be able to contribute more and it to go down as you get older. But we understand that, the statistics for people saving for retirement are pretty poor at this point. So Roth 401k, those are pretty new. I hadn't heard about them until a prior life. I had it has an option in my retirement plan. So we're going to talk about traditional 401ks in a little bit. But Roth 401ks this is after-tax money out of your paycheck that then gets put into a kind of separate account in your 401k, but it's after-tax growing.
Yes. So similar, it's exactly like a Roth IRA in what it does. You pay tax on the money before it goes in, then it grows tax-free. It's just in a different type of structure. It's in your company's retirement plan. So the benefit there is the contribution limits are then on the 401k contribution limit amounts. So we'll talk about that when the tax deferred, but $6,000 is what you could put in a Roth in 2020. For 2020 in a 401k, it's $19,500. So you can see using a Roth 401k, if you want to put a lot of tax-free growth in there, utilizing that gives you a lot more value in how much you can put in. So, and then again, if you're over 50, you get an extra like $6,000 in the catch-up as well. So there's a lot of room there. I think it's $6,500 in 2020 this year. So there's a lot of room there. If you want to put tax-free growth using a Roth piece, the Roth 401k gets you the most dollars in, and then a Roth IRA is available for anybody, whether or not your company has a retirement plan.
Exactly.
And so those are the tax-free growth. They're great on the other end. So that's how you put money in. On the other end, how do you take money out? Since you get that tax-free growth, the IRS says, this is IRA stands for individual retirement account. So the retirement piece in there, they're saying you're not going to retire when you're 25 years old. You're retiring when you're, 60s. And so they say, if you wait until 59 and a half or older.
There's those half years again.
I don't know what they're doing. There's probably some senator that was not 60 yet. He's like, I want to touch my money.
It's an actuarial table issue.
So if you're 59 and a half or older, you can withdraw with no penalty. And since it's a Roth IRA or Roth 401k, there's no tax. So once you reach that 59 and a half age, there's no restrictions on what you can withdraw out of the account. Prior to that, they give you some flexibility because they understand if you're putting money away, things happen. Any money you put in, you can pull out. So there's a 5-year window for Roth IRAs that you have to wait for. But other than that, you can take any money you put in, any dollars you put in, you can pull out, no tax, no penalty. Any earnings you withdraw, you'll owe tax and you'll owe a 10% penalty. So that 10% penalty is on top of the tax. So if you're in the 22% tax bracket, you owe 32% for withdrawing your money before you hit 59 and a half.
Penalties are rough.
Penalties are rough. And it's there to motivate you to grow it and invest it for retirement. Now, there are some exceptions for first-time home buying, for, if you're in some sort of health crisis or any certain situations you can apply.
Post-secondary education as well.
Yep. And so there's certain caveats to that as well where you can take money out and not pay that penalty. You'll still owe tax in almost all those situations, but there is no penalty. And like we saw here with COVID-19 at the beginning of 2020, they made some exceptions as well to some of these withdrawals that they extended and gave some relief to it as well. So it's not hard and true facts. They can be adjusted by Congress in certain situations. But in general, when you're planning on adding money, Roth IRA, Roth 401k, think long-term because accessing the money can cause quite a bit of penalties.
So we talked about taxable accounts where gains and dividends are taxed within the account in real time. Tax-free accounts, you already paid the tax on it. So no worries whatsoever. Let's talk in our third and final category.
Yes.
Tax deferred.
Deferred, meaning putting it down the road.
Putting it down the road.
Again, going back to Congress.
They love doing that. Why pay
they?
Tax today when you can pay tax tomorrow?
Right. Isn't that what the hamburger guy always said, Popeye the Sailor Man? He's always like, can I have a hamburger today and pay you tomorrow?
Oh, I was just thinking
good.
olive oil.
No, that was Popeye. So tax deferred. So tax deferred means that I'm not going to pay tax now, but sometime down the road, I will owe tax. So it's kind of the opposite of that Roth IRA. And so a traditional IRA, which was here before the Roth IRA.
It's traditional.
It's old. You put money in and you get a tax deduction. So you don't owe tax on the money you put into that IRA. Then it grows tax deferred until you withdraw the money. So from the time I put it in till the time I take it out, there's no tax owed. And it grows during that time tax free. But it's not always free. At some point, tax is due.
Government wants their tax.
Right. They have similar rules. They have income limitations for a traditional IRA. They also have the same restrictions on the other end. If you withdraw it before 59 and a half, you have the 10% penalty on top of the tax. And so those are all kind of similar. The income limits vary again, and same idea as the phase out. If you make above a certain amount, you can do non-deductible IRAs, which is similar to you pay tax on the money, it grows tax deferred, and you owe tax when you pull it out. So it's kind of not ideal, but for people that want at least a tax deferred growth, there's a way
Right.
of doing it if you make too much money for those limits. But high level, money grows tax deferred while it's in there, and then
Yep.
you owe tax when it's grown up. So going back to my example, I put $100 in. I've not paid tax on the $100.
Pre-tax money.
Pre-tax money. It grows to $1,000, and then when I take it out, I have $1,000 of income tax that I owe
Right.
on that withdrawal.
So typically this is taken out of, now what this does for you in real time. This is traditionally, the most common example of this is a 401k.
Yes.
So if you work at a larger company, chances are the retirement option you are given for the plan is called a 401k, and you put in X percent of dollars and your company will match X percent of dollars to go on top of it. It is literally the most beautiful. It's a wonderful.
Free money.
I love it. So anyway, what happens is, say you put in 5% of your paycheck, and say your paycheck is $1,000. $50 is 5% of that.
Yep.
Did I do the math right?
Yep.
Okay. So you only take home, before taxes, $900. Your income is not $1,000. Your income is $950.
Yep.
So your income tax is less.
Yep.
So what
That's
it's
not
doing,
taxed. That money's not taxed.
that money is not taxed. So what it's doing is it's lowering your current income taxes as well,
Yep.
which is kind of a nice thing. Now, the caveat that I'll throw in here is that these tax-deferred savings options they're really wonderful things, but with the way that our economy works and the way that our country and the fiscal and monetary policy and everything works together, it seems likely that taxes are going to be higher down the road than they are now.
Yep.
But the benefit of that is that hopefully when you're pulling this money out, your income will be lower, so you'll be paying less tax.
Yep. And that's always the thought is, my post-retirement income will be less than my working income. And so my taxes will be lower.
Yeah. Even if
just
rates
as a
are
result.
higher.
Even if rates are higher, I'm probably in a lower tax bracket,
Yes.
getting a lower effective rate. Yep. So traditional IRAs, 401ks, rollover IRAs, which is when you pull money out of a 401k and then put it into an IRA.
So like if you went to another employer,
Yep.
and you wanted your retirement out of your former employer's 401k plan, you could take it to your financial advisor and say, hey, I want to roll this into a rollover IRA, and they would manage it for you separately.
Correct. Then there's simple IRAs, SEP IRAs. There's all different types of, but when you see IRA, if it doesn't have the word Roth in front of it, it's tax deferred.
Gotcha.
403Bs, that's a fun one. That is the same as a 401k, but for nonprofits.
Yes.
So, a lot of hospitals operate as a nonprofit. So you see that. Schools, a lot of times universities, you'll see a 403B.
Yes.
It's a 401k just for the nonprofit world. Same rules apply. Then there's like defined contribution plans and defined benefit plans. Those are all different types of retirement plans you may run into. Defined benefit plans are a little less now. They're not as popular.
They were pretty much the only way
Pension.
to save.
Yeah.
You had
pension.
retirement for until 30, 40 years ago.
Yep.
Then that was really, you got a pension when you retired based on how long you worked there and how much money you made. And it was like a big complicated calculation and actuarial tables and all this other stuff. That's uncommon nowadays and becoming more and more so every single year because it's very expensive.
Yeah. So a defined benefit plan, think of it this way. So they're defining your benefits in the future, or they're saying, here's what you're going to get in the future, which is usually some sort of pension payout. Like every month you're going to get an amount. A defined contribution plan is the other way around. They're defining how much they're going to add in, and a lot of times it's a match. So if you put an X amount, you'll get X amount. That's what it's moving towards, because defining the future benefit is hard to do, especially as people are living longer. And that's what pensions have run into is, man, I thought people were only going to live into their 70s on average. Now they're living into their late 80s, early 90s. Our pension plan doesn't have enough money to cover everybody. And so that's why you see fewer and fewer pensions, is because of the cost of those. 401ks are more of a defined contribution plan because they're telling you how much they'll contribute into the plan on their behalf for you. And so that's more popular and becoming more and more the norm in what you see in large corporations.
Exactly. So Josh,
Yes.
it is a great day.
Great day. Well, yes, raining a little bit today, but it's all right.
It's a great day. I'm going to give you a gift on this great day.
Okay, I'm ready.
It's the dad joke of the week.
Dad joke?
I've been thinking of this one for literally a little bit of time. I found a good one. Oh, don't take a sip of water. You might spit it right out.
Oh, I'm ready.
Bum, bum, bum. How many tickles does it take before you can make an octopus laugh?
Oh, I know the answer to this.
Dang it,
But I'm going to let you say it because I love it. It's a
Tentacles.
tentacles. That's a funny word just when you think
Tentacles.
about it. Tentacles. That's how many tickles, though.
Makes so Pirates of the Caribbean, Davy Jones.
Yep.
The
little
you
face,
can't even see it because it's a podcast,
Yeah.
everyone.
But he's
I'm
doing the
Davy
tentacles on the beard.
Tentacles.
Yes.
But so we're debating what movie to watch tonight. We've watched the first, all except for the last of the Pirates movies. So that's one
At
option.
World's End, yep.
So At World's, or is it Dead Men Tell No Tales?
I don't know.
Whatever the last one is, we have it left.
Okay.
It's on Disney Plus. It's an option
Yep.
1. The other option is Tobey Maguire Spider-Man 1.
Oh, man.
Which would you
It's a
pick?
classic.
Which would you pick?
I've only seen the Pirates of the Caribbean, the fourth movie once. So I'm trying to remember it. Fifth, fourth? I don't know.
I think it's 5th.
If there's fifth, maybe I haven't seen that one yet. I don't know.
It's the one after The Fountain of Youth.
There's one after the Fountain.
Yeah.
Oh, man. Maybe I need to go watch that one.
Disney
So,
Plus.
yeah, so to answer your question, I'll probably watch that one because I have no idea what it is.
That is our biggest. That's the household discussion for the evening.
Okay.
So what's going to happen once our little one goes
man.
to bed?
Yeah, I mean, you can't go wrong with Spider-Man. Any of the Spider-Mans.
And I really like the newer ones too. So those are
Yes.
really good. Like
I
the Amazing
Yeah,
Spider-Man.
the Homecoming.
I've never seen that.
Those are good. Those are good.
So maybe our list is growing.
Yes. But you
So-
have to, if you're watching through all the Marvel movies, like you said, you got to wait
so
for those.
I know.
Because they tie into everything.
There's so much to.
Ah,
There's a lot of movies out there. So, Josh,
yes.
I think we should probably talk about the types of investments and the kind of overall thinking for these different buckets.
Yeah.
Not even specific accounts, but different buckets of accounts. So, as far as taxable accounts go, you can pretty much invest in anything you want. That's one of the things we talked about. The benefit is you can buy what you want, sell what you want, whenever you want, pull the money out whenever you want.
Yep.
You will be taxed in real time as this stuff occurs.
Yep.
So that's a beautiful thing. So the only caveat I would say, and we talked about it, is unless you want to incur that higher tax rate, then you should probably hope to hold things for at least a year.
Yeah. But you have really almost complete control of taxes
Yeah.
in that account because you're
Yep.
never forced to do anything
Exactly.
besides the mutual funds that kick out their distributions.
True.
But other than that, based on your holdings, your decisions, you choose what tax and how much based on what you do with your transactions.
And you can hold different things and buy and sell different things at different times and offset gains with losses. And there's a lot of flexibility that hopefully your advisor would be able to kind of walk you through as the options when tax time comes around. So the only, probably best, if possible, to avoid things that kick back a lot of cash your way.
Yep.
Those are going to be taxed in real time at higher rates. But other than that, pretty much do whatever you want. Now let's think about tax-free. So this is like HSAs, 529 plans, those kind of things. What can you invest in? Again, probably, a lot of options.
Yes.
Roth IRAs, these kind of things. ETFs, mutual funds, stocks.
Yep.
It's a beautiful world. You can invest in what you want. And these are great accounts to invest in things that do kick off a lot of cash your way. So high yielding dividend stocks, real estate investment trusts, like we talked about, have high yields, some fixed income, those kind of things. Great option here because you can get that cash flowing into your account and you are not taxed on it.
Yep. Or a higher turnover strategy where you're trading in and out more often.
Especially now with trading costs at none.
Yes.
So it's not a bad option at all there.
Not that we condone day trading by any
Correct.
means because, there's a lot of research involved to do that. But if there was a strategy or something that you're investing in where there is a lot of trades within an account like that, you're not going to be taxed on those trades as they happen.
Yes. So then the third bucket, tax deferred, like we talked about. So these are think like 401ks, traditional retirement plans. You can, again, probably invest in a lot of different options, but in most retirement plans, the most common is typically mutual funds. And that one thing that's really easy about that is you can buy partial shares. Dollar cost averaging with paychecks is very, very easy. So that is probably the most common, but there are often other different options in there as well. Target date funds are very common in today's retirement plans where, if you're coming out of college and you think you're going to retire in 30, 35, 40 years, you can just pick the nearest target date to when you think you're going to retire. And what it will do is be very growth-oriented and aggressive in terms of equity exposure when you're young and gradually shift over time. Now, I will put the disclaimer out there that that's an imperfect system, and it does so we're recording this in 2020. Don't know when you're going to listen to it, but a lot of those target date funds had a pretty rough beginning of 2020, even if they were closer to retirement.
Yeah.
So it's not a perfect system. It's a directionally okay system, and the idea is okay, but I will warn you, they're not perfect.
And like you mentioned, based on the type, so 401ks, 403bs, those that have that are tied to your company and your employment, they'll be choosing at least a menu of choices for you in most cases. Now, some give you the option to invest outside, but more often than not, you'll just be given a list of 15 to 20 mutual funds to choose from, or ETFs, whatever they're using. So you can be limited, but the structure itself does not limit you. It's just really the plan that could limit you. But rollover IRA, a traditional IRA, the sky's the limits. I mean, the same is true with the other accounts. You can invest in just about any type of investment structure that's there.
And in terms of dollars, for most people who are working today, this will be the category where the majority of your retirement dollars are being held in these tax-deferred accounts.
Yep. Now that they have Roth 401ks, you could get a little more, but up until that point, which is really just a handful of years ago that they started offering that, you were limited to just the Roth IRA, which was, again, this in 2020, $6,000. So you could see between putting $19,500 in a 401k and $6,000 in a Roth, most people did end up with a lot more tax deferred money than any other bucket.
So Josh, just kind of walk us through a little bit more high level thoughts on the different types of accounts and when money is taxed and that kind of thing, because they're very different, and I think they can be very confusing.
Yes. Yeah. So just kind of as a recap, taxable accounts, brokerage, those that are individual, joint, those type of accounts, they are taxed when transactions are made, whether in real time. Roth IRAs, those are taxed when the money goes in. So all the money's taxed prior to it being put into the account.
Correct.
Deferred tax accounts like 401ks and traditional IRAs, those are taxed when the money's pulled out. Correct. And we're going to talk, that's the last piece of this whole thing. Well, I guess there's two sides to it, is prioritizing adding money in and taking money out.
Yeah, so start with adding in.
Okay.
How would you, now it's different for everyone, right?
Yes.
So every single situation is a little bit different. That's why it's important to work with your advisor and, determine what the best allocation for how you put in and pull out your money. But as a rule of thumb, at a high level, how would you advise clients to prioritize adding money to their retirement accounts?
Yeah, so again, this is high level. Everybody's a little bit different and unique in their situation, but in general, the first and foremost thing you do if you're looking for retirement savings is add money into retirement plan at work if they're offering a match.
Free money.
Like Austin said, that's free money. So it's money that they're going to add into your account as long as you're contributing into it. If you don't put anything in, they don't put anything in, the money goes away. You don't get it in your paycheck or anything else. It goes away. So first and foremost, put in it as much as you need to get the company match.
So in a prior life, I knew that there were people who did not do that because they said they could beat it. And I said, how do you beat 100%?
Yeah.
Or whatever the match is.
Yeah.
You can't beat it.
Nope.
Free money, man.
Even if you don't invest it, you're just going to get double the money. Yeah. So
number one,
free money, put that in. Then the second spot really depends on your goals. And so that, again, we're talking retirement savings first and foremost. So once you get that, and then the next step, in my opinion, is the Roth IRA. I talked about as long as your income fits within the income limits, it being tax-free the rest of the time gives you a really nice savings vehicle for long-term growth. As we talk through compounding and the growth of money, to not have to worry about taxes on that growth is great. So your ending value ends up being better. And as an inheritance piece, the next generation, although there's some rules on what they can and can't do with it, they won't be taxed on the withdrawals. Mm-hmm. And so the next generation also has a nice tax break from a Roth IRA, tax-free money. So those are the two steps. And then after that, you can go back and add more money to 401k until you max that out. That's for retirement savings. Shorter term goals, those where those individual taxable accounts come into, because again, there's no restrictions. So if I'm saying, I want to save up for a car, but it's down the road and I can afford a little risk, I want to invest it. Okay, you don't want to put that in a 401k. You don't want to put that in a Roth IRA. That's a taxable account type of thing. So it all depends on what your goal is, short term, long term. But match first, Roth second, then you can fill up the rest after you get through the Roth. All right, let's flip around to the other side.
So how do you pull the money? Yeah, so
And
average Joe
says, I'm now in retirement.
Yep.
Let's make the caveat, we're in retirement. So I've already talked about prior to retirement, you really don't want to touch these accounts.
True.
Now I'm in retirement. I'm retired. My income's down. It's changed. I need to start drawing out. I'm over 59 and a half now, so there's no restrictions. What do I want to do? And that really just depends on your year. If you're going to have a year with income, so let's say you sell a business or sell a rental house or something where you have a large stream of income come in, I don't want to generate more income by pulling out of my tax-deferred accounts because every dollar that comes out of there is income tax. Maybe I'll take some money out of my Roth IRA so then I don't have any more additional tax. Or maybe I'll touch my taxable account knowing that it's capital gains, which is a lower than my income tax bracket. Flexibility is key. And we always say the more buckets you can have between those three buckets and the more you could be spread out between those, the easier it is to plan taxes in retirement. And so really the priority is how much room do I have in my current tax bracket? Which ones will help me fill that up without going to the next tax bracket?
Right.
And so it's really just a fun game of saying, okay, this year I could have 20,000 more of income before I jump to the next bracket. Okay, so I can withdraw about $20,000 from my IRA. Yep. At that point, I'm going to want to look at other ways so I'm not generating more income. And so it really is just a fun game. But on the flip side, prioritizing withdrawals really depends on your situation year to year.
Yep.
One year may be different than the other.
Yeah, because even if you're still working, but you're more than 59 and a half, if you want to buy a vacation home, it's probably better to take your money out of a Roth because you've already paid taxes on it. It's grown tax-free. You're not going to pay taxes on it taking it out or a penalty because you're old enough now.
Yes.
So you would then take that vacation money home out of something that you're not, as opposed to taking money out of your
401k, IRA.
Exactly.
Yep. And again, this is why having a good financial advisor comes into play, especially in retirement. Let's say I'm 65 years old and I'm going to do that situation that Austin just talked about. I want to buy a house. If I withdraw too much money and my income goes, in again, 2020, about $180,000, I now just increase my Medicare premiums. So withdrawing money for a house, which is great, I just now increase my costs for my health insurance in retirement.
It's a double whammy.
So paying attention to where you're pulling money from and what it's going to do to your taxes has a big impact on all different situations, especially, for someone who's in retirement and looking to preserve that wealth for the long run. You got to be very careful. So again, having a good financial advisor is key because they can help you through those situations.
Yeah, exactly. We're just going to rehash it again. The types of accounts that you invest your money in and how you withdraw them, super, super important to your financial success long term. And it's a tough thing to do on your own.
Yep.
So Josh and I want you guys to know that we are here for you. We are here to help. So don't hesitate to reach out if you have questions. We're more than happy to help. But mostly, if you don't have a financial advisor, we would encourage you to find one.
Yes.
And if you don't have one, we want to let you know that we are available to talk to you. And if you're curious to hear more of what we do at Hicks & Zerker Capital Management, check out the Invest With Us tab on our website, and we'll link that below in the show notes. We work with a team of dedicated, credentialed, experienced colleagues that have worked alongside our clients for nearly 2 decades to help them achieve their financial goals, and we can help you too. We don't want you to be in this alone.
And I will say, the one thing we didn't talk about, and these impact some of the accounts, is the required distribution. So at some point down the road, some of these account types require you to take some money out. So they do put a caveat because they're saying it's been growing so long, you need to take distributions. We're going to talk about required distributions in a podcast because that takes up its own podcast by itself because of all the rules and all the crazy things that have to happen with that. But that's the other side of this whole thing is when it comes to distributions, some of them actually force money out at some point in time. So that's one more thing to keep in mind when you're looking at these account types. But pay attention. We'll come out with that episode in a little while along with that. So again, thanks for listening. If you want to check out our website, like Austin mentioned, the Invest With Us tab, we also have a free gift. It has 8 principles of timeless investing for you. Also, if you like this podcast, you can subscribe to it, review us on Apple Podcasts if you can. Awesome. If you do that, we love that, seeing the comments and the reviews. Also, if you have any ideas or have any questions, shoot us an email at hello@theinvesteddads.com. We love interacting with you guys, especially for new podcast ideas, because we want to talk about what you guys want to know about.
And we read every email, and we'll get back to you.
Yes, definitely. So please share this episode. And again, if you have any questions, reach out to us.
Thanks.
Yep. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.